This was the age of the diversified conglomerate, in which the largest 200 came to own more than 60% of the country's corporate assets. ITT Corporation, set up as a telecoms company in 1920, had, by the end of the 1960s, bought up 300 other companies, including the hotel chain, Sheraton, bread maker, Continental Baking, timber company, Rainier, and Avis Rent-A-Car. The theory went that one company would buy another, which, following a 1950 antitrust law, had to be in a different sector, impose superior management, cost accounting and reorganization, and then reap the rewards. It was a seductive picture painted by accountants who had taken over the job of advising on investment decisions from the banks. The same post-Great Crash legislation that had split investment and commercial banks, the 1933 Glass-Steagall Act, had also barred them from advising on deals from which they would earn banking fees. But, with the accountancy firms also responsible for auditing the companies and standing to earn more fees advising on the many accounting issues thrown up by mergers, the result was simply to create another, arguably more harmful conflict of interest. For the increasingly commercial 20th century bean counter, it was, of course, good business. In fact, a critical rule change some years earlier ensured it was very good business. Black's mark. The accidental architect of the post-war mergers and acquisitions boom was William M. Black, an accountant who played a central role in the Second World War Lend-Lease Assistance Programme for Britain before going on to lead Peat, Marwick, Mitchell & Co.'s US arm. It was, however, shortly before this that he made his enduring contribution to corporate accounting. In 1941, Black was auditing chemicals company Celanese when it proposed merging with its rival in the synthetics business, the Celluloid Corporation. Both were successful companies, and the merger was expected to have what are now called synergies, i.e., commercial benefits. Yet, the effect of traditional accounting methods on the combined group's profits would be to suppress them, making it unattractive to the stock market. This was because Celanese would have to pay more for celluloid than its assets, such as its debts, stocks, plant and technology rights, like patents, were worth in isolation. There was nothing unusual about that in an acquisition, but the extra cost, which double-entry bookkeeping dictated would be treated as acquiring an intangible asset known as goodwill, would have to be written off over the following years. Predicted future profits would be reduced. Black reasoned that this would not give a fair picture of the combined enterprise, so he formulated a new method of accounting for such a merger, which he called pooling of interest accounting. If one company bought another with assets of, say, $60 million and liabilities of $40 million, i.e., net assets of $20 million, but paid $50 million for the acquisition, it would be paying $30 million for goodwill. Under traditional accounting, it would then have to write this off in its subsequent accounts, reducing or even eliminating later profits. But under Black's proposed system, the combined business would be accounted for as if it started from scratch, its balance sheet merely showing the buying companies and the acquired companies' combined real assets and liabilities. Its subsequent profits, which were what the stock market was interested in, would not be hit. Black's idea was treated with suspicion by the Securities and Exchange Commission, but it had delegated the task of drawing up rules and guidelines to the accountant's own professional body, now called the American Institute of Certified Public Accountants. Black's method was duly allowed under certain conditions, chiefly that the merging companies should be of similar size and in the same business. On the face of it, this wasn't a bad compromise. In fact, it set the scene for the de facto self-regulation of accountancy to chalk up its first major scandal. When takeovers peaked in 1968, the pooling of interests method was used in 60% of deals.